Hi everyone, and welcome to another episode of our webinar. This time we have something very different that doesn't really involve the hard real estate asset that people purchase. We always help our clients buy condos, lands, whatever it is they own. But this time we're going to talk about something that's really different. I'm here with Lawrence Raponi from Equiton, and he's going to tell us exactly what their company does and how it could benefit a lot of people out there. So Lawrence, thank you for coming.
Yeah, thanks a lot, Nima. It's a pleasure to be back here.
Amazing, thank you. So tell us what Equiton is and what you guys do.
Yeah, for sure. So Equiton is what many people refer to as a private equity firm, right? So we are a passive real estate investment option for many investors out there who want to get exposure to real estate as an asset class, but may have various obstacles to overcome in order to get there, whether it's struggling to come up with a down payment or struggling to get financing, or maybe you have, let's say, a ton of capital in your TFSAs or RSPs. You can't deploy that into something like a pre-construction condo or a duplex, but you can deploy that into private equity funds like Equiton's.
And so that's actually a great point, just to cut you off, because a lot of our people that are investing, if they can get financing, we tell them, let's say right now, maybe like go down the road of pre-construction, because then you don't have to get the financing right now, 5 years down the road. Or if you don't have the down payment, you can put installment. But I think with your option, it's better if you don't have access to that much fund, because even for pre-construction, you got to do 10, 15, 20% within a span of, let's say, a year to 2 years.
Exactly. You have to have that deposit on tap, right? Or at least have that financing in order, or else you might be in a position where you're forced to sell on assignment if you can't close on the deal. Passive real estate investments like Equiton's largely nullify all of those risks and allow the investor to come in at a pace that we'll say they're more comfortable with, right? So let's say if I'm speaking with a client today and they have something like $10,000 to invest today and that's all they have for whatever reason, that's absolutely okay. We can proceed with an investment. We can give them exposure to that asset class that they're looking for. Months or years go by, they've received that big bonus at work, or they get a windfall from a family member that had passed on and they want to redeploy more capital. We still have the exact same fund there, and we allow these investors to build on their positions over time, right? Okay. Similar to what you would find in something like the stock market.
Got it.
Right, where you can build a position over time.
So while we're here, so the asset class that you talk about, what asset classes do you guys have?
Yeah, so I think before we get right into that, it might be better to take a sort of step back and talk about just an overview of the different types of investment styles that we have.
Exactly.
So first of all, at Equiton, we're what we call a fully integrated real estate investment firm. And fully integrated essentially means that we do everything in-house, right? So there's a lot of other firms in our industry, and they will be the capital raise partner. So they're responsible for bringing in capital, and they'll partner with a real estate developer partner or a property management firm in order to derive value out of these investments. At Equiton, we actually do everything in-house. So we preside over every one of our properties and developments throughout that investment's life cycle. So on our fund side, with our buy and hold strategies, and we'll talk more about that, we are responsible for the full property management of these buildings, the ongoing operations. It's all done in-house, right? And that's a great way to both increase control of our properties and also minimize expenses. Now, on the development side, Equiton is both the capital partner and the developer partner. So everything is done fully in-house at Equiton. Wow. And the benefits are the same. It gives us more control, and it allows us to streamline expenses and reduce them. Right?
Got it.
Now, in terms of the types of investments we have, there's really two fundamental styles. We have our fund style investments and our development style investments. Now, the fund investments are generally lower risk, and the returns are commensurate with the amount of risk an investor is willing to take, but they have a few awesome characteristics. First of all, they're generally pretty liquid, which means you can move in or out of them as your situation dictates, right? Maybe you don't want to be tied into a 9-year project. Right. So maybe the funds might be a little more appropriate for you. Another characteristic of the funds is that both of them are cash flow generative, right? So if passive cash flow is an important part of an investor's investment strategy, the funds are a natural fit because both of our funds pay a monthly cash distribution.
Interesting. Yeah. So what's the minimum length that they got to be in these funds?
So we have what we call a soft holding period. Right. And that soft holding period is 5 years. However, our investors can actually redeem their investments at any time. You could purchase an investment today and then in 6 months decide that you want to go in a different direction, or God forbid there's a family emergency, whatever the case may be. And having that exit strategy, if you need to use it, gives investors a lot of comfort, right?
Got it.
Whereas the developments, once you're in a development project, you're in it until that development comes to completion, right?
Got
You
it.
can't decide 3 years through an apartment building construction project that you want out. It doesn't really work that way.
And then when you're getting the funds out, I'm guessing it affects the return, so you may not get the full return at the end of that year.
Exactly. So the way we've structured it at Equiton is that you can redeem at any time. However, if you redeem before the 5-year mark, there are early redemption fees to be paid.
Got it.
And the reason why we impose this, just in case you're interested, Nima, is because at Equiton, regardless of what investment we're talking about, we do employ a long-term investment strategy. We're not flippers. We're not buyers.
I mean, that's
we're
real
not
estate in
speculators.
general.
Exactly. It's a longer-term
Yeah.
investment. And a private equity firm like ours needs time in order to make efficient use of our investors' capital, right? If an investor comes along and uses our fund like a savings account, they're in it for 4 months and then they want to leave, it precludes us from us doing our job, which is going out there, investing that capital in good real estate properties and then driving value, right? So,
and is there a minimum required for the fund and the development?
yep. So our minimums vary depending on the type of investment we're talking about. So on the fund side, we have 2 core funds. One is a long-term buy and hold residential real estate strategy.
Right.
So we're going out there, we're acquiring apartment buildings and townhouse communities.
Right.
We're tenanting them with quality tenants. We're performing the necessary CapEx on them. So renovations, modernizations to common areas, beautiful landscaping, you name it. And we're driving the market value and the revenue that these buildings generate as high as possible. And a single investment in that fund is going to give you that diversified exposure to every property contained in the building.
Right.
And currently there's 28.
Wow.
Okay.
In different locations.
Exactly. Different locations. Now, on our balanced fund, it's more of a multifaceted approach to real estate investing. So we have a nice balance of 3 different asset classes. We do some buy and hold commercial real estate investing.
Right.
We also do a little bit of private lending. So there's an element of this fund that's actually private debt, not private equity. And there's a large chunk of this fund reserved for real estate developments. Now, this is the interesting part of the fund because this is where we'll say most of the profits are going to be derived from, right? It's really the main driver of value in the fund. The way I like to look at it is I'm going to invest in the balanced fund and I'm happy to take that monthly cash distribution up front coming from the private loans and the commercial properties, but really I'm in this project for the big returns coming from the developments, right?
Got it. And people can choose which funds they go in.
Exactly. So they're structured as similar to what you would find on the stock market, right? So if an investor comes to me and they have maybe $50,000 to invest, I would take a look at their personal situation, see what their existing real estate portfolio looks like. I'd ascertain their comfort level with risk, where they're at in their lives, so on and so forth, and we determine a best course forward, right? For a lot of investors, they're younger, they're very comfortable with risk, maybe they have a real estate investment portfolio themselves. For people like that, I would advocate them to go full in on our balanced fund, right? And really get that exposure to developments, right? But I also have clients that are closer to retirement, a little more conservative, right? And so for them, I'd recommend something like the residential fund, a little lower risk.
So the residential fund gives you the passive income monthly too?
Yep, they both funds pay a monthly cash distribution.
And what's the rate on those?
Yep,
like
so
roughly?
Both funds are the same currently. They're both paying 6%, and it's distributed on a monthly basis. And the idea here is, Nima, we wanted to mimic as much as possible physical real estate ownership. So this idea here is an investor has $100,000 to deploy in real estate assets. They know they want to be in real estate. They see the news headlines of it keeping appreciating. It's a very well-performing asset. Now, there's a few obstacles to that, right? Maybe they don't want to be a landlord themselves, right? Maybe their life's full at home. Maybe they have 3 children. Or maybe they're in retirement. They really enjoy and value traveling. They don't want to be tied down to a physical property. And for these types of people, the funds make a lot of sense because we're going to mimic that passive income coming in on a monthly basis, similar to if a tenant was paying them, let's say, but they don't have to do any of the work themselves.
And then if it's the first option, let's say they keep the money there, let's say it's 100,000. After 5 years, how much does that 100,000 increase, or is just the passive income that they're getting out of that?
No. So there's various components, we'll say, to profitability, and this applies to both of our funds, the residential and the balanced. There is that 6% annual distribution that's paid monthly. On the 15th of every month, just like clockwork, you're going to receive that cash flow. We've never missed a distribution. We've also never lowered our distributions, right? They're very stable, and in fact, they increase over time. But beyond that, you're also going to see appreciation of the actual buildings themselves, right? Just like when you buy a condo, let's say, and you're going to rent it out, you're going to take in cash flow. But over time, that condo is going to go up in value, right? 5, 10, 15, 20%. And so the actual principal investment continues to snowball upward as well.
Right.
Right. So there's two components to profitability.
And then when, let's say after 5 years, someone's invested 100 grand, wants to pull it out, and let's say that fund, whatever, that building has appreciated 20%. Does that mean like you guys every year appraise the buildings and then say, okay, you know what, if someone's invested, they're pulling out, they've been here for 5 years, now they can, let's say, roughly take, 20% out. So that's 120 grand you can take out right now.
Yep, exactly. So you can take out or put in as much as you'd like insofar as you hit our minimums, and we'll talk about that in a little bit. But in terms of the returns, brass tacks, the residential fund, we'll start there. It's a more conservative fund, generally lower risk. We target returns between 8 and 12%.
Yearly.
Okay, annual returns, that's right. And these returns compound over time. Now, not sky-high returns. This fund's not going to double your money overnight or anything like that. But that's not really its purpose. The residential fund's purpose in a person's portfolio is really meant to be this sort of pillar of stability, right? It's very, very consistent. It's very stable. It's never going to double in value overnight, but it's never going to drop 10% in value overnight either. In fact, this fund has been around for, I believe, 7 years now. It's never dropped a penny in value. We've actually never lost a cent of investor capital.
So you guys, when did you guys start it?
So we founded the fund in 2016.
2016. So I know like 2017, 18, there was a drop. Still, everything was fine.
Everything was fine. We came out through COVID with 0 downturns. It's just been, again, a hallmark of consistency.
Like out of curiosity, because let's just say someone put a fund down in 2016, 2018, values were lower. If someone was to pull it out, would the value of their money be lower at that point?
No, we've never had a downward revision to our asset prices. And to understand why, Nima, you got to understand how these types of institutional grade assets are valued, right? When you're an investor and you go out and buy something like a duplex or a triplex, you got to understand that there's a ton of speculation built into that, right? You're competing with other people's bids, driving prices upwards, especially in periods of low interest rates. When a company like ours and other companies like ours, when we approach an apartment building, we're going to pay $150 million for a building. We value these properties as businesses, right? There's no speculation baked into it. The price we're willing to pay for an asset of this size is simply a function of the revenues it generates, we'll say, right? So insofar as we can maintain revenues.
And that's why I like these bigger projects, because you guys go at it as a business, whereas I see it a lot, like in $1 million, $2 million, $5 million price point, a lot of people afford it, and there's a lot of speculation.
Exactly.
And the prices that people are paying, it doesn't make sense based on the revenue they're generating.
Exactly. We take an entirely different approach to real estate acquisition. We're much more clinical about it, right? And the reason is you need to be. When you're investing this amount of capital, especially when it's on behalf of your investor base, you need to make proper decisions, right? And so every company functions a little different. I will say at Equiton, we value downside protection as much as we value profits.
Which is key. Yeah. So now we're talking about that. Of course, with any investment, there's a risk involved with it. What would be like one of the risks that someone should be aware investing in, let's say, any private equity firm, not just yours, but overall or any REITs?
Yeah, that's a good question, and it's a common question I get from investors. An advantage of private equity is that because we're not publicly traded on something like a stock exchange, we're able to avoid all of that market risk, right? So our funds, our investments don't fluctuate up and down with the emotional whims of the stock market. That's really not how they work. They're much more stable. That's the positive side. On the downside, they're illiquid. And that just means, Nima, they're not easy to sell, right? And that is why we actually have that 5-year hold. And you have to think about it intuitively, right? It's if we wanted to sell one of our properties to pay back investors, it's not easy to sell a $200 million apartment building,
100%,
right? And so we have to have that minimum holding period to reflect the fact that these are illiquid investments.
And do you guys sell your assets? Have you sold assets?
To date, we've never sold a property. So we are long-term investors.
That's how it should be,
It's not part of our strategy. Doesn't mean we won't in the future. If someone gives us an offer we can't refuse, and we deem it to be in the best interest of our investors, then so be it. But we're not out there making profits by buying and selling.
Okay. So these were the different types of asset classes you were mentioning at the beginning. Anything else in this residential part or the commercial one?
No, I mean, with the residential fund, we're really not reinventing the wheel. It's a long-term buy and hold residential strategy. Very simple. The balance fund's going to give that diversified exposure to 3 different asset classes. You're going to have the commercial properties, the private lending, and the real estate development. That one being the major driver of profits. They're not overly complicated products. We don't go in there and try and reinvent the wheel. We like to go in there, minimize costs as greatly as possible, and drive returns that way.
Amazing.
Right?
And you mentioned something about development. What is a development fund?
Yes. So development is something that we're all really excited about at Equiton. It is our latest investment opportunity. What we've done is we've taken the developments that we're currently doing in the balanced fund, and we've broken them out separately so that investors, particularly high net worth investors that are more savvy and more comfort with this level of risk, can actually invest directly into these projects themselves.
Right.
Now, these development investments don't really have a fund structure to them. So a single investment in the development isn't going to give you this broad, diversified exposure to many different projects like the funds.
Right.
This is a direct investment in a specific opportunity, in a very specific market with a certain time to completion and a certain profitability structure. Right? And this appeals to investors that are looking for a little bit higher returns and more sophisticated investors who are comfortable with this level of risk that these types of projects give off.
Right.
Now, a few things about the developments. They are completely illiquid, which means if you're going to place an investment today and that gets purchased, you are locked in until the completion of the project. You can't pull out as you could in the residential fund, for instance. But
and the completion, we mean when the closing happens.
When
and
occupancy occurs.
Yeah.
That's right. But on the upside, these projects are incredibly lucrative. So whereas with our funds, we target returns anywhere between 8 and 16%. On the developments, we actually target returns upwards of 20% annually.
Right.
Okay. So these are the kind of investments where after a 5-year period, give or take, you're going to be doubling your money.
Interesting.
Right.
Interesting. Okay. And in terms of, again, because you make an investment, there's no guarantee that, it could be lower. It could be much lower than what you guys anticipate, right?
That's for sure. And anyone who's ever touched a development before will know there are no guarantees. No one has a crystal ball, no matter how intelligent they are, no matter how long they've been doing this.
You don't know what's going to happen in 5 years.
These projects have a life of their own. That's how I like to look at it, right? It's this own living, breathing thing with many, many moving parts. Something happens over here and it affects something down the road. Really, there are two main risks to these types of projects. You can either miss on your profitability targets, we'll say, or you can miss on timeline. Right? Now, I've been doing this a little bit of time now, Nima. In my experience, it's always the latter. It's the timeline that is the most variable. That represents the biggest risk to investors. And anyone who's ever purchased a pre-construction condo in the GTA will know that
delays.
It is common for projects to get delayed. Right? And so you need to be comfortable.
And it's because it's not in your hand. We had the strike a few months ago. For 3 months that was happening. And when the strike happens, you guys are delayed.
Exactly. When workers are off the job site, or a project can be delayed at the approval level, right? Maybe the city of Toronto is going to withhold site
so many moving parts
for whatever reason, right? And so the investor needs to be aware of those risks and understand the potential for something bad to happen. But I don't want to paint an overly negative picture, because on the other side of that coin, there always exists the potential for things to go very, very right? Our building construction costs can come in under estimates, right? We can come in ahead of schedule. We could end up selling at an average price per square foot above our projections, right? And so when you're ascertaining whether or not a project is worth getting involved in, you need to look at it holistically and say, look, what are the risks? Where are the ways that this project can go wrong?
Right.
And where are the ways in this where this project could surprise to the upside?
Exactly.
Right. And those are the two things you're juggling.
Right. And the development ones does not have the passive income portion.
That's correct. And again, think about it intuitively. When you're constructing an asset for the purposes of selling on completion, there's no intermittent cash flow coming off of it, right? So it's the type of investment where you're putting in your capital at T equals 0, ground floor, and you're getting a lump sum return at the end. Right?
So again, just to kind of summarize it, people who would take advantage of something like this would be essentially people who don't have the down payment, let's just say, for buying a property. 2 would be they can't get the financing they need, even if they have the down payment. And 3, it would be people, let's say if someone wants to buy a property, rent it, they don't want to deal with landlords.
Just don't want to be a landlord, or you don't have the skill set to be a landlord, right? A lot of people, they want to invest in real estate, but they're not equipped to build DCF analysis models on properties. They're not equipped to properly credit check their tenants.
It's funny because that's the bias we have. I never thought people would not want to be landlords. Being in the business, I see day in and day out that I talk to some clients and they're like, don't want to be a landlord, don't want to deal with residential tenancy and nothing. And that's a great solution for them, because up to now, I knew if someone didn't want to do that, they would go to a bank, put in a mutual fund. But what history has shown us, especially in GTA, real estate has been really solid.
Exactly. It's been a consistent outperformer as an asset class in total. time and time again, year after year after year, if you compare the overall profitability of any GTA-based real estate versus the TSX,
Right.
the real estate's going to be winning for the past 15 years,
Right.
right? And so tools or firms will say, like Equiton, allow investors to participate in the same sort of way they would in a stock, but getting exposure to the asset class that means something to them.
So, I mean, you guys are private equities, and I know there are REITs, and if you want to touch base on it, because a lot of people may not know, what's the difference between what you guys do and the REITs?
It's a good question, and it's probably the first question I address on all my introductory calls with clients. Our funds are effectively...
Let me just stop you here, because a lot of people may not know. REITs are real estate investment...
real estate investment trusts.
Trust, yeah.
Right? And maybe it's worthwhile taking a deeper dive into that. So a real estate investment trust is nothing but a corporation. It's a firm that goes out and acquires real estate assets, right?
Yeah.
As an investor in this trust, in this fund, you are sharing in the profitability, both in terms of cash flow and appreciation of all the assets contained in the portfolio. So you're getting immediate diversification with your investment in a REIT. Now, at Equiton, especially on our fund side, we offer nothing but REITs. That's exactly what they are. Why they're different goes back to why we are private equity. Because we're not publicly traded, we're not subject to the emotional whims of the stock market, right? Where if you hold a publicly traded REIT and inflation comes in hotter than expected, the entire stock market's going to drop that day, and your REITs with it, right? Now, is that because your REITs have become less profitable overnight, and that's why they dropped 4%?
No, it's just market sentiment.
Absolutely not. It's market sentiment. So being private allows us to be agnostic of this type of market risk.
And that's a positive about
exactly. They're just way more stable.
So what's the minimum required investment if someone wants to invest in any of your funds?
Yeah, that's a good one. So there are really three minimums based on our three investments, right? On the low end, we have our balanced fund with a $5,000 minimum.
That's amazing.
So very low, very, very approachable, right? Anyone can get involved. On the medium side, we have our residential fund, a little bit bigger of a fund with a higher investment minimum. That one's $10,000. And then on the high end, we have our direct investments and developments, and that is a $25,000 minimum.
Amazing. And there's no cap on how much you can invest, I'm guessing.
There isn't a cap per se, but we do have to qualify our investors.
The reason I'm asking is, do you get big institution investing in?
Absolutely. So again, every firm is different. At Equiton, we have three main capital raise channels. We have institutional clients. We also work with private wealth managers who invest on behalf of their high net worth clients. And then we have direct to investors. So people like yourself and myself just having the conversation.
That's amazing. Yeah. Well, I got to consider this right now.
Yeah,
it sounds really
it's certainly
good.
Worth it. And I'll always say to my clients, this is not meant to take the place of physical real estate ownership.
For sure, yeah.
Sometimes someone doesn't want to be in direct real estate ownership for the reasons we mentioned earlier, right? Don't want to be a landlord, can't come up with a down payment, so on and so forth.
And this is the exact reason why.
Exactly. It's a very viable solution for them. But oftentimes, and this is my personal story here, it's not meant to compete with these investments. It's meant to complement them, right? A private equity real estate investment is just another tool in the investor's toolbox to achieve whatever goal they want to achieve, whether it's long-term appreciation, cash flow, et cetera, et cetera. I myself own 11 doors of direct real estate ownership.
Amazing.
Right? But I still like having my funds because...
How do you like dealing with the tenants?
You know what? It's great until it's not.
Yeah.
Right. And one of my rentals is actually student housing, which if anyone's ever done the student rental before, you can relate to my pain. So it's
but the returns are good though.
Exactly. These types of assets, they're cash flow machines until you have a problem. But I like having the private equity investments because it's not something I need to worry about, right? When I see my stock portfolio fall 7% because Russia decides to invade another country or a new city in Ukraine or a new COVID variant comes out, I just don't need to worry about my Equiton investments. They're just this hallmark of stability.
Yeah.
Right?
And this is why if someone says, I can't get into Toronto's real estate, this gives you a foot in a door to get exposure to real estate. Put your money somewhere with the real estate as it's growing. I mean, right now, the average increase in the real estate in GTA for the last 20 years, we were just doing the stats yesterday, 8.1%. That's amazing. I mean,
it's astounding. But I want to pose a question to the audience. Has your income gone up annually 8.1%? And the answer is invariably no. And that's the problem. There's this disconnect between asset prices and affordability. It's rendering a lot of these types of alternatives untenable, right? It's very, very hard to come up with that down payment and then to service that debt, especially with rising interest rates, right? So again, companies like Equiton are a very viable solution.
And just for people out there, one source that they can use the funds would be TFSAs and RRSPs that they have.
Yes, that's right. So another advantage to these private equity companies that invest in real estate is that you can invest with registered and non-registered accounts.
That's amazing.
So we can accommodate LIRAs, TFSAs, RRSPs, RESPs if people have children. Really any account under the sun we can accommodate.
So, the returns that you get are pretty solid, and we know in GTA the real estate has performed really well. So that gives you that peace of mind that if you have something in TFSA or any other account that you may have, it would grow with the real estate market in Toronto.
Yeah, for sure. And it's actually been a boon for us now that we're seeing the public market selling off, because people are now taking a review of their portfolio, right?
Exactly.
They're starting to see that, wow, markets just don't go up and up and up forever. Maybe I should consider putting away some of my profits into something a little more stable,
That's amazing.
a little more conservative.
Great.
Right?
Yeah. Well, Lawrence, this was amazing. I mean, for me, it was very informative. I'm pretty sure a lot of people didn't even know this product existed. If anyone needs to reach to Lawrence, you can contact me, contact Lawrence. We're going to have Lawrence's contact below as well. And hope you guys enjoyed it. And hopefully we'll see you on the next webinar. Have a great day. Lawrence, thank you.
Yeah, thanks so much, Nima.
Thanks.